as a general rule, corporations are greedy, right? I mean, a small business can operate differently because it could be more heavily influenced by its leadership team, its founder. Uh, but when you're a large distributed entity, your general goal is profit maximization. And so whether it's Coca-Cola or whether it's banks, I mean, pretty much any sector you look at, they're always going to try to maximize their profits. And, especially when you're a smaller bank and you're looking at the JP Morgans of the world, like they're holding rates at zero because they can, because no deposits want to flow out of them. If you're a small bank and you're sitting there saying, well, if we raise rates, now we have worse funding costs than JP Morgan, as well as all the other disadvantages we have compared to JP Morgan. And so I think banks only raise deposit rates when they have to. It's kind of like it's the market at work. Basically, if they're not getting signals telling them they have to raise deposit rates, they won't. And if they start getting signals to raise deposit rates, then they will. And of course, the problem is that it can kind of happen all at once. Like they could not get the signal, not get the signal, not get the signal. But then if suddenly people are concerned about bank safety, they get all the signal at once. And so, bank greed has always been a theme. And just I think like any other company, banks are pretty much always greedy. And there's smaller banks that are serving their community. Like I have a local credit union. Their rates, their deposit rates are terrible. But they're not really operating on like a greedy perspective. I mean, they're serving their community well. There's really no excess compensation going on. They're just kind of operating in the rates environment that they're given. And so I think that's kind of what we see overall is that it's kind of the market kind of all the water just keeps settling to where it goes. And if it starts to drain out, then they have to raise rates to keep it in. Yeah, I think that so it's more market driven. It's also Fed driven. I mean, Fed, it's rather reckless with how quickly they move
Right.
things up and down. And then I think where the banks had the most say in how they manage things is with how they manage their duration risk, right? So obviously something like Silicon Valley Bank was on the far side of the spectrum for not managing that well.
Yep.
And obviously there's various choices that banks can make to not have that type of exposure. I think the reaction kind of shows what happens when no one's really in charge, and yet they're all kind of a little bit in charge, right? Because you've had this kind of haphazard response where one is they clearly didn't see it coming. Um, the Federal Reserve response so far has, nothing's been really unusual about that. They provided liquidity facilities. They're generous in some ways, but they're still at punitive rates. I mean, if any bank is using that new, Fed liquidity facility, that's way higher rates than they're going to get from deposits. So if they're, yeah, if they're tapping into that, they're having a bad time. The FDIC's response, which also is kind of, they can act unilaterally. I mean, if they go above their normal functions, they have to then talk to the Federal Reserve Board and the Treasury and the President to do things like cover uninsured deposits. So that was more of a group decision. That shows how arbitrary that is. Basically, I mean, there's between the Treasury Secretary and the FDIC, the question of what deposits are insured and what are not, we've been flip-flopping all around on. We start with a pretty defined set of rules. You're covered up to this threshold. If you're over that threshold, you're at risk. And when we change the rules on the fly, and we're more likely to change the rules for big banks than small banks, that they were basically favoring big banks that already have a number of advantages over small banks. We're basically saying that you have free extra insurance.
Right.
And then the thing is, she won't even commit to that. She won't even be clear about that because she actually doesn't have full authority because the FDIC only has so much money.
Right.
And if they wanted to do some sort of blanket coverage on all deposits, they'd have to get an act of Congress. And so it's kind of a mess. It's both like in that role, it's hard to even know what to say because if you say, these are the rules, that's what it is, well, the system is so fragile that those rules don't really work well with it, that you basically encourage more bank runs. On the other hand, if you say, okay, everything's FDIC insured, one is you don't really have the authority to do that unilaterally. You can't really necessarily back that up just from the executive branch. And two, it's like, then what are we doing here? Like, why it basically makes deposits look safer than they really are. Basically, they're at the pause phase. Now, whether or not they try to push a little bit further with another 25 basis point hike or something like that, I mean, around the margins, we'll see. So far, I currently agree with market pricing that they're going to have trouble with anything other than a pause or gradual moves now. When we zoom out to kind of the bigger question, I often bring up the 1940s, and that's really what they find themselves in. So if we go back to the 1970s, the inflation that was happening was a couple key reasons. One is you had the highest ever rate of U.S. bank lending, and that was in large part because the baby boomer generation was entering their home buying years. So you had most of the money creation was from bank lending. Then number two, that was exacerbated by there were larger fiscal deficits. Now they were actually a smaller component of money creation than bank lending, but they were still adding fuel to the fire. And of course you had oil issues, right? So domestic oil production peaked in 1970 after literally going up for 100 years. And then as it started to go flat to down, we became more reliant on imports. And then obviously we ran into geopolitical issues in the Middle East where we got cut out of the market for periods of time. And so the combination of supply side limitations, but then also record demand for loans really caused a lot of money creation and inflation. And generally the tool that central banks have to deal with that is to tighten policy, especially because debts as a percentage of GDP, both public and private, were very low back then. And so they could radically tighten monetary policy, get to really positive real yields, discourage a lot of types of borrowing, put the economy into kind of a controlled recession. They basically crushed Latin America. I mean, basically they had all this dollar-denominated debt. The dollar spiked, and Latin America had a lost decade, and that basically took demand out of the global market, so that basically United States could have more of it. So it's kind of like throwing one person under the bus to keep yourself afloat. That's the policy they could go with. The 1940s were a different environment, which is that the money creation was almost entirely from fiscal spending. There was no excessive bank lending. Actually, banks were barely lending at all in the 1940s. And yet that decade was just as inflationary as the 70s, because obviously you had massive monetized fiscal deficits to fight the war. But then a lot of that, went to domestic manufacturing. When the soldiers came home, it put 8 million of them through technical schools and college and mortgage assistance and things like that. It's just basically a gigantic stimulus in a way, monetized, inflationary. And when the Fed had to deal with that situation, they basically lost independence. They said, well, we have to keep borrowing costs low for the war. And ironically, if most of the money creation is coming from fiscal spending, raising rates doesn't even necessarily address it, because the government's not going to spend less because rates are high. And now their deficits are going to be bigger because they're paying higher interest on their debt. And so actually, unlike bank lending, the interest rate channel is just not a very effective way to deal with fiscal driven inflation. But the most effective way to deal with fiscal driven inflation is to reduce the fiscal deficit, which is not a central bank. It's not in their purview. It's in Congress and the president. And so basically it's their current environment is that here in the 2020s, most of the inflation's from large monetized fiscal deficits as well as supply side constraints. We don't have excessive bank lending. There's pockets of excessive bank lending, but it's just the normal kind of historical baseline of bank lending. And yet they're treating it like it's the 1970s, which is they're treating it as though it's low debt, as though it's mostly from bank lending, and therefore if you're tight enough with rates and QT, you can somehow constrain it. And sure, you can for a period of time if you cause an outright recession. But if you actually want to get to a period of disinflationary growth, the ways to do that are improve the supply side, so better access to energy and things like that, as well as restructure some of the deficit spending. But neither of those are actions that the Fed has. And so I think that one of the problems is that we put so much burden here on the Fed to deal with it, and it's just not. They're only one part of the puzzle in this kind of mess that we've created over the past couple of decades. And so
the weapons they have are not effective, or not as effective for this particular situation.
And the challenge is that, so the way that they dealt with it in the 1940s is, one is they kept rates low despite high inflation. But then the problem is, if you keep rates too low during inflation, then you can actually encourage excessive bank lending, because right now in Turkey, if you can borrow lira for a low rate, why wouldn't you? You buy almost anything else if you can if they're not going to raise rates to positive real levels. And so if they don't raise rates in response to fiscal driven inflation, they can then encourage bank lending driven inflation because everybody wants to borrow more of it, create more of the currency, and buy something harder with it. And so what they generally turn to is a mix of keeping interest rates low or moderate, and then doing capital or lending controls, which obviously is a big problem in its own right. And so I think that's kind of the environment that we find ourselves in going forward, where they have limited tools to address inflation directly, unless they want to cause an outright recession. And even if they do, then the question is, well, what do you do after the recession? How do you accelerate without causing another round of inflation?
Right.
And I think one of the things they're going to try is just basically tighter restrictions on bank lending. They're basically trying to slow down bank lending while still keeping treasury markets liquid. And it's kind of the 1940s playbook all over again.